Equity Markets Overview: Understanding the mechanics, performance, and strategies of global financial markets. Navigating the world of equity markets and indices for better investment decisions. Introduction. Equity markets and indices are critical components of the global financial system. They are used as measures of economic performance, investment performance, and as tools for risk management. The equity markets allow companies to raise capital by issuing shares to the public, while indices provide investors with a way to track the performance of a particular market or sector. This book provides an overview of the equity markets and indices, including their history, mechanics, and performance. The world of finance is vast and complex, and equity markets and indices are two crucial components that help us navigate this complexity. Equity markets provide a way for companies to raise capital, and for investors to buy and sell shares of those companies. Indices, on the other hand, allow us to track the performance of a particular market or sector. This book is intended to provide readers with a comprehensive review of equity markets and indices. It will cover the history, mechanics, performance, strategies, risks, and regulation of these essential components of the financial system. By the end of this book, readers should have a deeper understanding of how equity markets and indices work, how they are used, and what factors can affect their performance. Whether you are an individual investor looking to make better investment decisions, or a financial professional looking to expand your knowledge, this book is for you. So, let us dive into the fascinating world of equity markets and indices, and explore the ways in which they shape the global financial landscape. Chapter 1. History of Equity Markets. This chapter explores the history of equity markets, starting with the earliest stock markets in the 17th century and ending with the modern equity markets. The chapter highlights the evolution of the equity markets and how they have changed over time. Equity markets have a long and fascinating history, dating back several centuries. The earliest stock markets emerged in Europe in the 17th century, and they were primarily used to finance trade ventures and colonial expansion. Over time, these markets grew in size and complexity, and they became key drivers of economic growth and development. One of the first stock markets was established in Amsterdam in the early 1600s. The Amsterdam Stock Exchange, also known as the Beurs van Amsterdam, was created to facilitate the trade of shares in the Dutch East India Company, one of the largest and most powerful companies of the time. This allowed the Dutch to raise significant amounts of capital to finance their overseas expansion, and it paved the way for the growth of other stock markets across Europe. The London Stock Exchange, which was founded in 1801, is one of the oldest and most well-known stock exchanges in the world. It was established to trade government bonds, but it later expanded to include shares in other companies. By the mid-1800s, the London Stock Exchange had become a major center for international finance, and it played a key role in financing the expansion of the British Empire. In the United States, the New York Stock Exchange, NYSE, was established in 1817. Initially, the NYSE was focused on rating government bonds, but it later expanded to include shares in other companies. The NYSE grew rapidly during the 19th and early 20th centuries, and it became a symbol of American economic power and prosperity. In the modern era, equity markets have become more global and interconnected than ever before. The rise of electronic trading and the increasing importance of index funds and other passive investment strategies have transformed the way equity markets operate. Today, equity markets play a critical role in the global financial system, and they continue to shape the trajectory of economic growth and development around the world. Chapter 2. Equity Market Mechanics. This chapter focuses on the mechanics of the equity markets, including the primary and secondary markets, the role of brokers and dealers, the different types of orders, and trading strategies. The chapter also covers the concept of liquidity and its importance in equity markets. Equity markets are complex systems that involve a variety of participants, including issuers, investors, brokers, and dealers. Understanding the mechanics of equity markets is essential for anyone looking to invest in these markets. This chapter will cover the primary and secondary markets, the role of brokers and dealers, the different types of orders, and trading strategies. Primary market. The primary market is where new securities are issued and sold for the first time. Companies can issue new shares of stock or bonds in the primary market to raise capital. In the primary market, securities are typically sold through an initial public offering, IPO, where the company sets an initial price for the shares and sells them to investors. Secondary market. The secondary market is where previously issued securities are bought and sold among investors. The most well-known secondary market is the stock exchange, such as the NYSE, Nasdaq, and London Stock Exchange. In the secondary market, investors buy and sell securities through brokers or dealers, and prices are determined by supply and demand. Brokers and dealers. Brokers and dealers play a crucial role in the equity market. Brokers act as intermediaries between buyers and sellers, executing trades on behalf of their clients. Dealers, on the other hand, buy and sell securities for their own account. Both brokers and dealers must be registered with the appropriate regulatory bodies and comply with various rules and regulations. Types of orders. There are several types of orders that investors can use when buying or selling securities. The most common orders include market orders, limit orders, and stop orders. A market order is an order to buy or sell a security at the best available price. A limit order is an order to buy or sell a security at a specified price or better. A stop order is an order to buy or sell a security when it reaches a certain price level. Trading strategies. There are several trading strategies that investors can use when investing in equity markets. Some of the most popular strategies include value investing, growth investing, momentum investing, and index investing. Value investing involves buying undervalued stocks with the expectation that their price will increase over time. Growth investing involves buying stocks in companies with high growth potential. Momentum investing involves buying stocks that have recently performed well, with the expectation that their upward momentum will continue. Index investing involves buying a portfolio of stocks that tracks a particular index, such as the S&P 500 or the Nasdaq Composite. In summary, equity markets are complex systems that involve a variety of participants and mechanisms. Understanding the primary and secondary markets, the role of brokers and dealers, the different types of orders, and trading strategies is essential for anyone looking to invest in these markets. Chapter 3. Equity Market Indices. This chapter provides an overview of equity market indices, including the types of indices, how they are constructed, and how they are used. The chapter covers popular indices such as the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite, and also includes information on international indices. Equity market indices play a crucial role in the world of finance. They allow investors to track the performance of a particular market or sector, and they provide a benchmark against which to measure the performance of individual stocks or portfolios. This chapter will cover the basics of equity market indices, including how they are constructed, how they are used, and some of the most well-known indices. What is an equity market index? An equity market index is a measure of the performance of a particular market or sector. It is typically calculated by taking a weighted average of the prices of a select group of stocks. The weightings are typically based on market capitalization, which is the total value of a company's outstanding shares. For example, the S&P 500 is an index of 500 large-cap stocks listed on U.S. exchanges, weighted by market capitalization. How are equity market indices constructed? Equity market indices are constructed using a variety of methodologies. Some indices are market cap weighted, which means that the weightings of individual stocks are based on their market capitalization. Other indices are equal weighted, which means that each stock in the index is given the same weight regardless of its market capitalization. Some indices are sector specific, focusing on a particular industry or sector, while others are broad-based, covering a wide range of industries and sectors. How are equity market indices used? Equity market indices are used in a variety of ways. They allow investors to track the performance of a particular market or sector, and they provide a benchmark against which to measure the performance of individual stocks or portfolios. Indices can also be used as the basis for index funds, which are mutual funds or exchange-traded funds that track a particular index. Some of the most well-known equity market indices, S&P 500, tracks the performance of 500 large-cap stocks listed on U.S. exchanges, weighted by market capitalization. Considered a benchmark for the U.S. stock market. Nasdaq Composite tracks the performance of all the stocks listed on the Nasdaq exchange, which is home to many technology companies. Dow Jones Industrial Average tracks the performance of 30 large-cap stocks listed on U.S. exchanges, selected to represent a diverse range of industries. FTSE 100 tracks the performance of 100 large-cap stocks listed on the London Stock Exchange, weighted by market capitalization. Nikkei 225 tracks the performance of 225 large-cap stocks listed on the Tokyo Stock Exchange, weighted by price. In summary, equity market indices are a vital tool for investors, allowing them to track the performance of a particular market or sector and providing a benchmark for individual stocks or portfolios. They are constructed using a variety of methodologies, and some of the most well-known indices include the S&P 500, Nasdaq Composite, Dow Jones Industrial Average, FTSE 100, and Nikkei 225. Chapter 4. Equity Market Performance. This chapter focuses on equity market performance, including historical trends, volatility, and factors that affect equity market performance. The chapter also covers various metrics used to measure equity market performance, including returns, risk-adjusted returns, and market capitalization. Equity market performance refers to the returns that investors can expect from investing in stocks. It is an important measure of the health of the economy, as well as a key factor in determining investment strategies. This chapter will cover some of the key metrics used to measure equity market performance, as well as some of the factors that can affect stock returns. Key metrics for measuring equity market performance. Total return. The total return on an investment includes both capital gains, the increase in the value of the stock, and dividends, the payments made to shareholders. Price to earnings ratio, P/E ratio. The P/E ratio is a measure of how much investors are willing to pay for each dollar of earnings that a company generates. It is calculated by dividing the current stock price by the company's earnings per share. Dividend yield. The dividend yield is the percentage of the stock's price that is paid out in dividends each year. Factors affecting equity market performance. Economic indicators. Economic indicators such as gross domestic product, GDP, inflation, and unemployment rates can all have an impact on equity market performance. For example, strong GDP growth and low unemployment rates may lead to higher stock returns. Corporate earnings. The earnings of individual companies can have a significant impact on their stock prices and the overall performance of the equity market. Positive earnings reports can lead to higher stock prices and vice versa. Interest rates. Interest rates can affect the performance of the equity market in a variety of ways. For example, low interest rates may encourage investors to take on more risk by investing in stocks rather than bonds, which can lead to higher stock returns. Geopolitical events. Geopolitical events such as wars, natural disasters, and political instability can all have an impact on equity market performance. These events can cause uncertainty and volatility in the markets, which can lead to fluctuations in stock prices. Conclusion. Equity market performance is an important measure of the health of the economy and a key factor in investment strategies. Investors can use metrics such as total return, P/E ratio, and dividend yield to evaluate the performance of individual stocks and the overall equity market. Factors such as economic indicators, corporate earnings, interest rates, and geopolitical events can all have an impact on equity market performance. Understanding these factors and how they can affect stock returns is essential for successful investing. Chapter 5. Equity Market Strategies. This chapter covers different equity market strategies, including value investing, growth investing, momentum investing, and index investing. The chapter also covers the pros and cons of each the strategy and how they have performed historically. Equity market strategies refer to the approaches that investors use to make investment decisions in the stock market. These strategies are typically based on a combination of fundamental and technical analysis, and they can range from conservative to aggressive. In this chapter, we will explore some of the most common equity market strategies. 1. Buy and hold strategy. The buy and hold strategy involves investing in stocks for the long term, with a belief that the overall trend of the market will be upward over time. This strategy is based on the idea that it is difficult to time the market and that it is better to hold onto a diversified portfolio of stocks through market fluctuations. This strategy is considered conservative and is often used by investors with a long-term investment horizon. 2. Value investing strategy. Value investing involves investing in stocks that are trading at a lower price than their intrinsic value, based on an analysis of their financial statements and other fundamentals. Value investors look for stocks that are undervalued by the market, with a belief that their true value will eventually be recognized and lead to price appreciation. This strategy is considered conservative and is often used by investors looking for stable long-term returns. 3. Growth investing strategy. Growth investing involves investing in stocks that are expected to grow at a higher rate than the overall market. This strategy is based on the idea that these stocks will eventually outperform the broader market due to their strong earnings growth potential. Growth investors often look for companies with innovative products or services, strong management teams, and a competitive advantage in their industry. This strategy is considered more aggressive and is often used by investors looking for higher returns. 4. Momentum investing strategy. Momentum investing involves investing in stocks that have shown strong price performance over a period of time, with a belief that they will continue to perform well in the future. This strategy is based on the idea that stocks with positive price momentum will continue to attract investors and drive prices higher. Momentum investors often use technical analysis to identify stocks with strong price trends. This strategy is considered more aggressive and is often used by short-term traders. 5. Index investing strategy. Index investing involves investing in a diversified portfolio of stocks that tracks a particular market or sector index. This strategy is based on the idea that it is difficult to beat the overall market, and that investors can achieve similar returns by investing in a low-cost index fund or exchange-traded fund, ETF. Index investing is considered conservative and is often used by investors looking for long-term, low-risk returns. Conclusion: equity market strategies can range from conservative to aggressive and are based on a combination of fundamental and technical analysis. The buy and hold, value investing, growth investing, momentum investing, and index investing strategies are some of the most common approaches used by investors. Each strategy has its own advantages and disadvantages, and the best approach will depend on an investor's risk tolerance, investment horizon, and financial goals. Chapter 6: Equity Market Risks. This chapter explores the risks associated with investing in equity markets, including market risk, interest rate risk, and credit risk. The chapter also covers ways to manage these risks, including diversification, hedging, and risk management techniques. Equity market investments can offer high returns, but they also come with inherent risks. These risks can be divided into two broad categories: systematic and unsystematic risks. In this chapter, we will explore some of the key equity market risks that investors should be aware of. 1. Systematic risks. Systematic risks are those that are inherent in the overall equity market and affect all stocks. These risks are also known as market risks and cannot be diversified away. Examples of systematic risks include economic risks. Economic risks arise from macroeconomic factors such as inflation, interest rates, and GDP growth. These factors can affect the overall performance of the equity market and, in turn, the performance of individual stocks. Political risks. Political risks arise from changes in government policies, international trade agreements, and geopolitical events. These factors can cause uncertainty and volatility in the equity market. Market risks. Market risks arise from changes in investor sentiment, supply and demand imbalances, and fluctuations in global markets. These factors can cause volatility and affect the performance of individual stocks. 2. Unsystematic risks. Unsystematic risks are those that are specific to individual companies and can be diversified away by investing in a diversified portfolio of stocks. Examples of unsystematic risks include business risks. Business risks arise from factors such as changes in the competitive landscape, product recalls, or negative press. These factors can affect the performance of individual companies and, in turn, the performance of their stocks. Financial risks. Financial risks arise from factors such as high levels of debt, poor financial management, or accounting irregularities. These factors can affect the financial health of individual companies and their ability to generate returns for investors. Management risks. Management risks arise from factors such as poor decision-making, leadership changes, or inadequate succession planning. These factors can affect the long-term prospects of individual companies and their ability to generate returns for investors. Conclusion: equity market investments come with inherent risks, including systematic risks that affect the overall equity market and unsystematic risks that are specific to individual companies. These risks can be managed through diversification and by understanding the underlying factors that drive stock prices. Investors should be aware of the risks associated with equity market investments and develop a risk management strategy that aligns with their investment goals and risk tolerance. Chapter 7: Equity Market Regulation. This chapter covers equity market regulation, including the role of government regulators, self-regulatory organizations, and international regulatory bodies. The chapter also covers recent regulatory developments, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act. Equity market regulation plays a crucial role in maintaining the fairness, transparency, and stability of the equity market. In this chapter, we will explore some of the key equity market regulations that exist around the world. 1. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is a regulatory agency in the United States that oversees the securities industry, including the equity market. The SEC's primary role is to protect investors by ensuring that the securities industry operates fairly and transparently. The SEC enforces laws such as the Securities Act of 1933, the Securities Exchange Act of 1934, and the Sarbanes-Oxley Act of 2002. 2. Financial Conduct Authority, FCA. The Financial Conduct Authority, FCA, is a regulatory agency in the United Kingdom that oversees the financial services industry, including the equity market. The FCA's primary role is to ensure that the financial industry operates in a way that protects consumers and maintains the integrity of the market. The FCA enforces laws such as the Financial Services and Markets Act 2000. 3. European Securities and Markets Authority, ESMA. The European Securities and Markets Authority, ESMA, is a regulatory agency in the European Union that oversees the securities industry, including the equity market. The ESMA's primary role is to promote the stability and integrity of the financial system in the European Union. The ESMA enforces laws such as the Markets and Financial Instruments Directive, MiFID II. 4. Japan Financial Services Agency, JFSA. The Japan Financial Services Agency, JFSA, is a regulatory agency in Japan that oversees the financial industry, including the equity market. The JFSA's primary role is to protect consumers and ensure the stability of the financial system. The JFSA enforces laws such as the Financial Instruments and Exchange Act. 5. China Securities Regulatory Commission, CSRC. The China Securities Regulatory Commission, CSRC, is a regulatory agency in China that oversees the securities industry, including the equity market. The CSRC's primary role is to maintain the stability and transparency of the equity market in China. The CSRC enforces laws such as the Securities Law of the People's Republic of China. Conclusion: equity market regulation plays a crucial role in maintaining the fairness, transparency, and stability of the equity market. Regulatory agencies around the world enforce laws and regulations that protect investors, maintain the integrity of the market, and promote the stability of the financial system. Investors should be aware of the regulatory environment in which they are investing and understand how regulations may affect their investments. Conclusion: equity markets and indices play a vital role in the global financial system, and understanding them is essential for investors and financial professionals. This book provides a comprehensive overview of equity markets and indices, covering their history, mechanics, performance, strategies, risks, and regulation. By reading this book, readers will gain a deeper understanding of equity markets and be better equipped to make informed investment decisions. Equity markets play a crucial role in the global economy, allowing companies to raise capital and investors to generate returns. Understanding the history, mechanics, indices, performance, strategies, and risks of the equity market is essential for investors looking to participate in this market. Additionally, being aware of equity market regulations and how they can affect investments is crucial. While equity markets can offer higher returns, they also come with inherent risks that investors must manage. These risks can be divided into systematic and unsystematic risks, and they can be managed through diversification and risk management strategies. Finally, Investors should approach the equity market with a long-term perspective and a clear investment strategy that aligns with their investment goals and risk tolerance. By doing so, investors can take advantage of the opportunities offered by the equity market while minimizing their exposure to risks.